Welcome everybody to our third Wook in Review, Wook Capital's weekly roundup of major news topics that are impacting financial markets. I'm Rod Alsman. I'm the managing director here. And just before we get underway, do need to read a disclosure to dot our I's and cross our T's. Need everybody to be aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on the information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, with that mouthful out of the way, thank you everyone for tuning in to our third weekly Wook in Review. We're live streaming from Tampa today. Back at home, I have power, I have internet, I have the luxuries of modern society that we take for granted that I unfortunately did not have last go around. Joe is telling me to tick a box for a better viewing experience for the folks on Discord. I'm not sure where that box is. Oh, okay, for everybody else. Got it. So yes, folks joining on Twitter Live, thank you for tuning in. Folks joining in the Discord, I have that up on my second screen. You can see my first screen, and we're going to go through, as I mentioned, what's going on with the Twitter Elon Musk deal, and kind of talk about the EV landscape more broadly. There's been a bunch of news, both last night with Elon purporting that Tesla will begin making deliveries of the Semi, as well as just in the automotive EV space as well from Ford and others. So got a lot of good content. My plan today is to take this up to 2 hours, up to 6 o'clock Eastern, depending on how much input we have from the audience. Definitely want to welcome and field as many questions as possible. I think the prepared content we'll get through in much less time, and then we'll really open it up and see where the conversation goes. So thanks everybody again for tuning in. I'm going to shift now to this third Wook in Review. You can, if you haven't already, sign up for it by joining the Wook Capital Discord server at wook.gg, and the newsletter sign up link is there. We just ask that you introduce yourself to gain full access to the server. So we are breaking down the latest Twitter and Elon developments in the EV landscape. I'm going to get the Twitter and Elon stuff out of the way. Joe, I'm bringing you up as a co-host, and please, as folks do want to join in and ask questions, you can submit questions via the text through the voice chat in the Wook server, and of course, if folks are joining just audio only via Twitter, when we get to that point, please, we welcome all sorts of questions. So, okay, Elon and Twitter, this thing's been going on now for 6 months. When will it end? There does appear to be a deadline. So earlier this week, on October 4th, on Tuesday, we got news that Elon had sent a letter to Twitter basically proposing to close the deal on the original terms. And what was this deal? What's going on? If you don't remember, in 6 months ago, it feels like a lifetime ago, in April, Elon had, and let me actually pull up, I think Matt Levin laid it out quite well. And I have this Matt Levin's fantastic newsletter writer. He writes the money stuff newsletter for Bloomberg. And this one from this morning has a little bit of a synopsis for those who are viewing on screen. Otherwise, if you get money stuff, you might know what I'm talking about. So on April 4th, Elon signed an agreement that he would join the board and not make a hostile bid. 5 days later, decided not to join the board. And then 4 days after that, he made a hostile bid for Twitter. There was noise that we won't go in deep detail about his delay in filing his, both inappropriately, in my view, filing on Form 13G as a passive investor. Should have filed on 13D, in my opinion, and that of many others. And he also was belated in his filing, supposed to file within 10 days of passing that 5% threshold, and it went quite beyond that. So he was able to purchase shares at a lower level, given the market was not made aware in a timely manner of his acquisitions. He went up to, I believe it's 9.2%, give or take, and that's where he's currently still at. So he then signed the merger agreement in April 25th, and then less than 3 weeks later said, nope, deal on hold. Lots of Elon Musk shenanigans, and now we are where this Twitter has been forced to try to sue for specific performance to compel consummation of the deal under the original terms. Elon on Monday sent this letter, right, where he plans to close the deal on those original terms. And his lawyers said, well, let's stop the trial. There's no need for an expedited trial to order the defendant, Elon, to do what they're already doing. And this is blah, blah, blah. Now, Elon was supposed to be deposed yesterday. I believe it was yesterday. And it does seem like the risk of him being deposed and having to provide some testimony under oath may have been what scared him into finally wishing to consummate the deal. The deal's not closed yet, right? It's close to the finish line. For those who are watching, saw the stock price on Twitter, and I'll just pull up the chart. You can see over the last year to date, actually, it's probably better. You see it declined really up until when Elon began buying. He was buying in March, and then the disclosure came out, of course. He had this offer for the 54.20, excuse me. And in April, the price shot up toward the deal price. And then when Elon said it's on hold, whatever that means, the price fell back down meaningfully. So, there was plenty of arbitrageurs who participated in the trade who, I think that the consensus view by and large was that Elon is looking to get out of this deal, right? The macro economy has deteriorated year to date since he took this course of action in March and April. The comparable companies in the space like Pinterest and Snapchat and Meta have all traded down meaningfully. So, and the price that he agreed to, where he waived his due diligence, is a pretty hefty premium to where I think most agree the stock would be trading today in absence of the deal. But he signed a deal. Twitter and the board is looking to compel consummation of the deal. Elon has said he wants to close the deal. His letter had some wishy-washy language in it about having the funding, which he has a bank debt commitment for $13 billion worth of the $46 billion to be covered by some capital market raises, with Morgan Stanley leading that. And we're at this point where the judge has basically stayed the trial for 3 more weeks. So October 28th is basically the deadline for Twitter and Elon to complete the agreement. And if they have not done so by October 28th, then the trial will go on. The show must go on. Musk will be deposed and so on. So it does seem that others that I've read, including the Chancery Daily, who's a fantastic Twitter writer on the subject, is that the deal will be closed at the 54.20 agreed upon price sometime between now and the 28th. The out for Elon, I guess, right, is that if he did not have, and I'm trying to find the part in Matt's right up here to kind of cite it, that is, if his banks didn't fund their debt commitment, then he could get out of just paying his $1 billion reverse termination fee. Now, the banks actually would probably prefer not to fund the $13 billion in debt commitment because capital markets have deteriorated, credit spreads have widened, risk-free rates have risen, and this is actually going to cost banks, according to both Levin and others, I've seen estimates in excess of $1 billion in terms of them eating a loss because they're going to have to fund the deal. It's a very risky debt. It's junk, and with spreads being what they are, they're going to have to sell the debt for a discount in all likelihood. So as bankers get screwed, Twitter shareholders, if the deal does close, come out handsomely. Those who've held throughout the entirety of the roller coaster ride. But yeah, we will see what happens. It seemed like the deal could close this week. It can close at any point, really, between now and the 28th, before the court resumes and, in all likelihood, holds Musk's feet to the fire and would force consummation through the specific performance provision in the contract. I've heard folks kind of opine. I think there was a former Delaware judge who opined that maybe the court wouldn't force Elon to buy something he didn't wanted, but on the other hand, if you don't have a system of law, if you don't, if Delaware's Chancery Court can't compel specific performance, what's the point of that provision even being in contracts going forward? So I don't think it's in the court's best interest to see specific performance challenged like that. I do think that the deal does close, and Musk ends up paying, what he agreed to pay when he waived his due diligence, and then he raised a litany of other issues he had with the purchase after the fact. But it does not appear that any reached that very high hurdle of being a material adverse effect, MAE, that would enable him to get out of the deal. So it seems like this drama is shortly drawing to a close. We'll see. With all things Elon Musk, it's, I don't think, a done deal until the robot dances or the fat lady sings, whichever your preferred one is. But he said he will be looking to close the transaction at the 54.20. So that's what's going on with Elon and Twitter. We can definitely circle back to talk more about it, but I'd much rather talk more about electric vehicles. It's a topic I'm extremely passionate about. I'll just share a little bit of personal history with me and EVs. The first car I ever bought out of undergrad in 2010, I bought a Ford Fusion Hybrid new when I went to work at Bank of America. They had an incentive program where I got Ford employee pricing, and I received a $3,000 credit from the bank for buying a new hybrid vehicle. So I have experienced hybrid driving. I bought a Chevy Volt several years after that I drove for 6 years and enjoyed it. I switched to a VW GTI, and within the last month, I actually bought another used Chevy Volt. So I've had hybrids, plug-in hybrids. I've driven electric cars. When I worked at Ryder System in corporate strategy, a very serious part of my focus was on vehicle electrification, specifically on the commercial vehicle side, but I monitored the consumer side quite closely for several years. So I've been following all of this for a while. And one of the things that is a truism, that is a certainty with electrification, is that regulation is and has been and will continue to be a primary driver of this adoption, right? We've seen it happening in Europe, in China, in the newsletter. I believe I included it, but I don't know if I made the final cut, but you have these 2035 now internal combustion engine bans that are coming around for both the EU, California. China's not 100% finalized. But the regulatory levers have been really pushing vehicle electrification forward for some time. And there's a whole lot of things that this impacts, right? The entire automotive supply chain, where are these manufacturing facilities located? What does the consumer think of this? There are various secondary impacts of all of this. Lithium mining, right? What do you do with the used batteries, et cetera, recycling? So, it's a very big world change. And I'll highlight a few different stories through the prepared remarks, and then definitely welcome kind of an open discussion on what's going on in the EV market. But Bloomberg Hyperdrive, I think, is a fantastic source. Bloomberg does some great coverage of all things green. That they certainly, with BNEF, their Bloomberg New Energy Finance arm, do some great primary research. And I'll cover a little bit of theirs. But this week, Michigan awarded various incentives out to attract new vehicle production and battery production projects. one of the things that you need to think about when you think about the supply chain is, with internal combustion engines, you have transmissions, you have the raw steel and aluminum that's going into the vehicles, and supply chains were developed in a way that back in the 1900s, you had iron ore in Minnesota, for example, in Michigan, in the Upper Peninsula, and that iron ore would have to be either by rail car or by barge, brought to production facilities. Which, of course, Henry Ford famously set up the first assembly line in Detroit, and Detroit's been the Motor City for since then. To get the raw commodities to these facilities, that's why we've gotten now the U.S. government's passed the Inflation Reduction Act, right? So there's various incentives in the plan for both producers, consumers, et cetera, to encourage and attempt to accelerate adoption of electric vehicles. So there's these various production tax credits. There's tax credits for electric vehicle buyers extended through 2032. If you recall, there was previously a tax credit, but the way it was structured was not so favorable necessarily to consumers who maybe didn't have the cash to wait and for a tax credit come tax time in the next year. There's now a used EV tax credit, the commercial EV tax credit, which is up to 40,000 off, which is a very meaningful chunk if you're talking about a truck. So we'll definitely talk about the commercial side of things as well. The infrastructure, right? The charging equipment itself, as well as make-ready infrastructure. All of these are components of this ecosystem that the U.S. government is now allocating some very significant heft to encouraging. And you've got these battles going on between states. Michigan's trying to retain as much automotive industry as they can. You've got other states, right, in the South, maybe union-free states, right, that are looking to attract more and more investment from whether it's the legacy American OEMs or your Korean, Japanese, or Europeans. So there's this battle going on within the states. There's this battle going on between not just the states, but between nationalities. Because after this Inflation Reduction Act, you've actually got. I thought I pulled the article up. Perhaps I didn't. But you've got lawsuits really from other countries, potentially coming down the pipe through the World Trade Organization, because you have this very America-oriented Inflation Reduction Act, right, trying to localize production in the U.S. or North America, and this is obviously not good for, say, a South Korean OEM who may have production facilities based in South Korea or in Japan, and now those vehicles won't be eligible for the full entirety of these various tax credits and incentives, which again, as I said on the onset, regulation has been the primary enabler for really accelerating things in this direction. Second to regulation, I would argue the battery cost curve has been a really big factor in it. And I had a visual, this visual here in the newsletter for breaking down the cost of an EV battery cell comes from Bloomberg New Energy Finance. They do an annual survey of what the average both cell and total all-in battery pack cost is in kilowatt hours, in dollars per kilowatt hour. And the trend has been for this, I have so many visuals. One sec, let me pull it up. But the trend has been for costs to continue coming down, really. So the visual I have on screen, this is from November 21. This is BNEF's annual battery price survey. And the prices fell 6% from 2020 to 2021. And this graphic here, I'll zoom in on it, showing that volume weighted average pack price. Like if you go back to 2010, it was over $1,000 per kilowatt hour. So if you think about something as simple as a plug-in hybrid like a Chevy Volt, which the first generation Volts had, let's call it 16 kilowatt hour battery packs. You're talking about a battery pack that costs $16,000. 16 kilowatt hours, it was only getting you, call it 40 miles of range. So you still then had a $16,000 battery pack plus all of the internal combustion engine componentry, and all of the other costs. So it's really hard for Chevy with the Volt to make money off that product. Now, the magic of adoption beyond regulation has been this cost curve, the massive reduction in battery cost from the early 2010s through to last year has been a huge enabler of why Tesla has been able to produce these vehicles and profitably make them. And they've obviously been ahead of the pack with regard to getting their battery costs down, and others have played catch up as they've tried to scale. But what has happened this really last year and change is that this curve has kinked upwards, and we don't have, and we will have in about a month or so, the 2022 survey findings. But I would expect that given how much the input costs have risen, you actually see this curve kink upward. In the article I have on page, you see that the head of metals and mining at BNEF noted the prices for lithium have risen substantially this year, and this was a year ago almost. So those prices are still elevated. So as demand keeps growing, right, if supply does not keep lockstep with it, then eventually that price, that cost curve may reverse. So it'll be very interesting to see if we get our first kink upward in price. I think it's a foregone conclusion. It remains to be seen what the average looks like, because this is a function of both scale in terms of production scale. It's a function of improving chemistries, which has happened over the years. I don't know how Bloomberg does the math behind this, right? To maybe do a weighting based on what are the chemistries going into it, because something like a lithium iron phosphate, which has lower value, doesn't require cobalt, it doesn't require the same amount of lithium as maybe a nickel, an NCA or an NMC battery chemistry would. So the LFP has definitely gotten more in favor, especially on the lower value products. I think Tesla's cars that are made in China, for example, and sold in China, I think exported to some other markets, are made with the LFP packs, which don't perform as well in certain weather conditions. They don't have quite as much power. There's some downsides to it, but obviously the big upside is the cost factor. So kind of continuing along, you see in the graphic again that the majority of the cost of that cell is the cathode material itself, which is why OEs like Tesla have been leaning into LFP, because cobalt and lithium and nickel and manganese are so expensive that if they can reduce the mix of the cathode material that requires the expensive rare earth metals and get a comparable experience or output, then why wouldn't we put the lithium iron phosphate battery packs in? Okay, I kind of included some details on Ford, and I think it's really interesting to think about. You've got really difficult decisions that leaders at companies like Ford, GM, and the other legacy OEs have had to grapple with, of what is the right mix of investment to put into EV versus my legacy business. EVs aren't making me profits. My legacy business is the one driving my profits. And Ford, they've been pretty clear that they expect the legacy business to keep driving those profits. And what they actually did, and what others are contemplating doing, is basically separating their businesses. So in Ford's case, they're not explicitly spinning off their electric vehicle business, but they have internally restructured Ford such that it's very clear. There's the Ford E for the electric products, and then there's the legacy Ford internal combustion engine business. General Motors hasn't done something quite to that extent. In this Bloomberg article I have up, this is from March. This is talking about what they looked at, and Ford did look at the spinoff. The decision, the idea was they didn't need to sell it into public markets. They didn't need to raise capital, right? And I think that's what GM settled on, is they don't need to raise capital to fund what they're doing. They just need to ensure they have the incentives internally aligned properly. And it's definitely easier for someone like Tesla, who they are a pure play EV OEM, right? You have the Rivians, the other various startups that have come public in the last few years. That's to say nothing about their attractiveness as an investment, but to note that it's easier for them, being dedicated to one thing rather than trying to optimize the mix between what is eventually going to go away and what is the growth business that still doesn't make money. I pulled up this article here talking about from this week as well from Volvo Cars. So Volvo a few years back was one of the earlier ones. I think it was 2017, as early as 2017, they were making announcements that they would be going all electric and they would be shying away from their internal combustion engine business. They were definitely at the forefront of the legacy OEs, but they, with Geely, who is a Chinese business, who's their parent company, they had actually come out this week and said, well, other legacy OEMs, we want to work with you. We want your legacy business to consolidate with our legacy business because we know that internal combustion engines are going to be in demand for years to come. And we don't think that we should completely stop improving and enhancing internal combustion engines. The quote from the head of the VW powertrain unit was, the worst thing that could happen to the climate in the world is that there's no further development of these technologies. Combining different assets from other OEMs would absolutely make sense economically. It's quite an expensive product. And during my time at Ryder, I saw this where Navistar, which has now been acquired by Traton, which is Volkswagen's truck unit, they had been working collaboratively on a next generation big bore diesel engine going back 5 years or so. And these engines get done every several years, these overhauls, and they become a little bit more efficient. They become a little bit more powerful. And the idea is that there's still, even though the internal combustion has been iterated on for over 100 years now, there's still room to go to continue making them better. And in many parts of the world, internal combustion engine will exist for years to come. I think there's a very much a debate that could be had over what is the right mix, right? Is it 100% EV like some people want? Is it let the market decide? Is it somewhere in between? It's certainly not the right solution for every problem, right? Putting an electric vehicle in certain areas just geographically right now, at least with the infrastructure in place, doesn't make sense. But yeah, we'll talk a little bit about that as well. So you've got kind of the OEs potentially collaborating and either spinning off their ICE units or spinning off their EV units to try to unlock value. Because when you look at the valuations, right, you look at the valuation that Tesla has been granted by the market and that these other EV startups have been granted by the market, despite no profits from many of them yet. Obviously, Tesla does report a profit now. Nonetheless, it trades at a very steep, demanding valuation that high growth must continue in near perpetuity. But when you look at players like GM and Ford, and you see these single-digit price-to-earnings ratios, and it seems that the market's giving very steep discounts to the legacy businesses, even though those will continue to generate cash flows for the foreseeable future. So we talked about cost. Obviously, want to highlight the example this week of the Ford F-150 Lightning Pro, which is the cheapest version that had, when it went on sale in May, not even 6 months ago, started at under 40,000, and now it's starting at 52,000. So 6 months and 30% price increase. That's pretty darn inflationary. And Ford has also noted that the input cost increases, be it both raw materials as well as labor, those have risen so much so that Ford's profits on EVs have gone poof, and that they've had to raise price just to tread water. So it's not that they're minting money, but as this article that I have on screen kind of notes, that they're trying to improve profits, but it's hard to make money for a lot of these legacy OEs still on electrification. So with that, let me keep going. We talked about the Twitter deal already. So let's talk about the commercial EV side of things. Elon noted that they're going to begin deliveries by December 1st, which It was back in November of 2017. So it will have been more than 5 years since the Tesla Semi was first unveiled in November of 2017. I remember it. I watched it. I was working at Ryder at the time, and I remember sending a note to the C-suite and others about what was going on because that was my job. And I sat in a Tesla Semi prototype in April of 2019. And it does look like that prototype may finally be making it to production. There's still no answer on where the vehicles are being assembled, if it's its own assembly line, what sort of scale of production we can expect for the Semi. As a reminder, and I'll pull up the screen here, the Semi is a Class 8 tractor where this is a work truck. This is built for the purpose of getting work done, moving freight from A to B. I want to be careful about how much I say that is non-public pertaining to Semi, but I think they've said publicly kind of their intention was to use Semi between the Nevada Gigafactory and the Fremont facility to haul supplies between the two, completed battery packs. I think that's a known thing. So we're talking about, they're claiming a range of 500 miles, which if you're a driver, you're going to exhaust your hours of service, right? That the drivers only have so much drive time they're permitted to have on a daily shift. That if there's truly 500 miles of range loaded at max capacity and a driver's hauling this freight, then they're not losing work time, and this could be an effective work vehicle. I think that remains to be seen. I'll show a screen here. When I worked at Ryder, we had the opportunity to speak with really all of the new and incumbent OEMs. I was on a team that was our job as part of the team to speak with these different OEs, understand what their build plans were, what their production schedules were, what they expect to come in the next several years on the medium and heavy duty commercial electrification front. And this slide is from Ryder's Investor Day. I remember working many hours on this sort of analysis. I wasn't part of this particular analysis. I left the company by then, but they put this out in their 2022 Investor Day earlier this spring. And it basically shows that on the Class 8 side, that Semi falls into, the anticipated total EV production is 1 or 2% of new Class 8 vehicles. In 23, it's 1%. In 24 and 25, it's 2%. From medium duty, think about like a 26-foot box truck might be your Class 6, right? Your 26-foot box truck with a lift gate might be your prototypical Class 6 truck. Class 7 will be a little bit bigger than that. But the estimate is still in the low, finally hitting mid-single digits by 2025. Now, obviously, the Inflation Reduction Act having passed since then adds that up to 40,000 or up to 30% discount, which is definitely an accelerant for adoption. So this analysis would likely be revised upwards. But I remember looking at this in 2017, and all of the estimates for adoption have fallen and gotten pushed out and been delayed. And it was telling to me that Elon only brought Semi back up really after this $40,000 incentive came out. So it goes back to my point. Regulation and kind of the related incentives or disincentives are what's been pushing adoption more so than necessarily a true, at least on the commercial side, it will be total cost of ownership. It will be TCO. It will be, this truck can get the work done for me for less. I can have the same or better uptime. I can have the same or better labor cost, because to Elon's point about the acceleration, that saves you time as a truck driver in your workday when your truck can accelerate more quickly from a stop fully loaded. So if you're a drayage driver working between the ports in Southern California and you have a lot of stop and go, if you can effectively get work done more quickly, then that could be accretive. You obviously have to weigh out the other operating cost considerations and the higher capex, and when do you break even? And the other point is, okay, well, financing costs are rising, right? And this is not just for consumers, but also for commercial vehicles. But the capex premium is so great on these vehicles that their relative attractiveness will fall off faster as interest rates rise. If you're financing, a $300,000 tractor versus a $150,000 tractor, that incremental 150,000 and borrowing at an incrementally, 2, 3, 4, 5% higher interest rate, that adds up very quickly and eats away at your prospective savings. So there are a whole lot of considerations when it comes to electric vehicles that are going to drive adoption. You've got that battery cost curve, right, that has been coming down, but appears to have either be stalling out or it may just be a blip. We'll see. You have these different regulatory forces that should enable faster adoption and or scare people away from wanting to invest in internal combustion. But the opportunity, I think, on the internal combustion side is that, well, people aren't, and you won't have new competitors, right? You're not going to have new entrants enter the internal combustion space in all likelihood. You'll have a dwindling pool of legacy players as that slice of the pie does get smaller and smaller over time. But as I noted, my view is that it will never go fully away, whether it's developing markets that continue not having the necessary infrastructure or the sheer demands of rare earth, in getting enough material to actually create enough of these vehicles to truly be able to produce, tens and tens of millions globally annually, such that EV is the only way. So, touched on a whole lot of EV related content in that kind of 35 minutes, as well as the Elon Musk Twitter deal. So that's the prepared content we had for this week's Wook in Review. I'm going to pause there, and really, if anyone has any kind of questions, want to go in a different direction, want to talk more about any of these articles or any of these data points pertaining to EV, I would be happy to do so. So, Joe, I don't see anything queued up, but let's gather questions as folks wish to ask. You can ask questions in the voice chat text if you're in the Wook Discord right now, or if you're on Spaces only, please feel free to request to speak, and let's keep the conversation going.
Rod, one question I have, I don't know if you understand the nuances of the $40,000 commercial credit, but is that exclusively for new commercial EV equipment, or would that qualify used vehicles?
Yeah, so for commercial equipment, it's new only. There is a used component for consumer. It's got, so here's the new tax credit for commercial EVs. So this is, as I mentioned, first time ever. This is through 2032. So we have 10 years, barring some change in regulation between now and then, where the eligible credit amount is the lesser of 30% the sales price, or the incremental cost of the vehicle. It's up to, and it's capped at 40,000. So that's GVWR, gross vehicle weight rating, of more than 14,000 pounds. So this is, I think that's class 4, but you might, class 4 plus. So, we're talking again, class 4 through 8 commercial equipment. You think about a delivery van like Amazon might be operating. Those are typically class 2 or class 3 vans, so those wouldn't be eligible for the 40,000. Again, with all things regulatory like this, you get weird, perverse incentives where it may make sense to actually build class 4 step. Class 5 is a typical step van if you think about a UPS step van. So UPS may be disproportionately benefiting from this versus, say, other players who are operating van-only fleets. So it is just for new vehicles, must be used for business purposes. The used part is this new tax credit for used EVs, where they have to be sold from a dealership. They need to be under a certain price range. They need to have a certain size battery pack. And it'll start in 2024, I believe, for those used consumer EVs. But yeah.
Thanks, Rod. I added up some new speakers here. Jake, why don't you go first?
Sure. I guess my question, Rod, as always, I come with the complicated questions is, what do you think the incentives are going to be on battery manufacturing? And do you see the bottleneck here not being from a price point, but from a logistics standpoint of not having enough lithium available to sort of meet this demand, no matter how much tax credits are sort of given?
Yeah. So I've seen different analyses on rare earths. I haven't stayed hyper close to it. To your point of, is it a constraint on the capacity for OEMs to produce these vehicles at and meet market demand? I, it does seem like there's going to be that in the shorter and medium term, right? Tesla's kind of been vaunted as having secured these longer term supply agreements, and you've seen on the legacy side that some have struggled with getting the same sort of scaled sourcing. I think about OEs like VW and GM that have been at the lead, and then you think about others that have really been laggards, and maybe it's Stellantis, for example, that they're just maybe now starting to launch their first like fully electric products. I mean, Toyota is well known to have had great success with the Prius and with hybrid products, but they've been of the view that until solid state batteries become commercialized, that true scaled adoption will be a challenge. So like my take is that, yeah, we're going to have a few years here where, look, Tesla's had quite the run in the last couple of years, because you have this situation where they have the best software on the vehicles. They can repurpose the automotive chips that they were using, I think, in ways that legacy OEs that were maybe using very simple, whether it's a very basic chip to control something like a windshield, not windshield, your windows going up or down, or some very basic task that these basic automotive chips that the chip makers weren't necessarily interested in making during the last couple of years. The automotive OEs, a lot of them kind of cut their orders in 2020, and then they went way to the back of the line, those that did that. And people like GM and the like have been racing to get those chips for some time. It's like, I know it's not purely related to your point about manufacturing, but it kind of is related that there's a lot of challenges that they've been facing amid COVID, beyond just the transition to electrification. I know Scott is on, and he's done plenty of research. And Scott, you're welcome to chime in if you wanted to add anything. But it does seem like in this messy middle where we are a mix of EV production that's ramping and going through this S-like curve, and internal combustion slowly going the way of the dodo in some spaces. That yeah, you're going to have various OEs, and having control of your supply chain, having sourcing agreements, having commitments to get the necessary raw materials could be the difference between success in the transition and failure. And who's best positioned, right? Like there's different folks have gone about it different ways. Ford with the F-150 decided, let's just repackage the existing F-150 for the most part, add a couple of features here and there, but not have like a bottom-up purpose-built chassis. Whereas General Motors has done Ultium and has this very modular, flexible production that can be used for both commercial vans, as on their GM BrightDrop product, as well as all the way down to passenger cars and somewhere in between with Ultium. So the different approaches, I think it's hard to say who will be the most successful still, right? Because you've got people on one end of the spectrum, Toyota, the people on the and Stellantis, you got people on the other end of the spectrum who've gone all maybe more all in, like your Volvos. But yeah, sourcing of materials, getting the plants in place, and having that supply chain. Clearly, Inflation Reduction Act is going to near shore a lot of production, assuming that there isn't some sort of WTO ruling that prevents that, in my view.
I guess my question was more focused on sort of the R&D side of developing new battery technology and sort of to structure around sort of those constraints. And that's obviously one of the big advantages that Tesla has, is that they sort of came out with the new battery technology.
Yeah, right. So Tesla definitely likes to talk up everything Tesla, but they're not really the ones doing it, right? It's a joint venture with Panasonic, who's the one who's actually making the cells. Now they've obviously got the different form factor, the 4680, that doesn't, as far as I can tell, seem to have reached commercial scale in meaningful volume yet. I mean, yeah, if you have a true groundbreaking chemistry, I think that could vault somebody ahead. But what I have right now up on screen, you can see that all the OEs globally, it's Tesla's not on this because they're not a battery manufacturer. Panasonic's the battery manufacturer. CATL is the battery manufacturer. Now there's along the spectrum of who's making the cells, who's making the modules, who's making the packs. It varies by OE. I know years ago, Mercedes-Benz had desired to enter the cell making space, and they made a decision that no, there's not really an edge to be had in the cells. It's more in the module and the pack construction. There's different viewpoints, I think, industry wide on that. But it will definitely be interesting to see the shift away from Asia and toward both Europe and North America for battery manufacturers. And I mean, really, to me, the magic bullet is once you get a solid state commercial product, that changes things, because then you have enough density that a lot of these applications that might not make sense for electrification today, where you're losing payload capacity because the battery pack is so heavy, with how much density you get, because diesel fuel is like 5 times more dense from an energy perspective than these battery packs are. So for now, right, that's the best that a lot of these fleets who are doing like over the road trucking can go with. And obviously commercial and consumer are different, but yeah, I don't know that Tesla truly has an advantage in the cell side of things. I know some people feel strongly that they do. They've obviously gotten very far in electric motors. I think that's an interesting space, right? Thinking about internal combustion, the engines have been iterated for 100 plus years. Electric motors, yes, they've been around, but do you mount the motors on the wheel? Do you mount the motor on the e-axle, right? What's the optimal type of electric motor to use? I think electric motors have a lot of runway to improve and become more and more efficient, and possibly reduce the amount of energy per mile that's being consumed. And I would argue for sure that Tesla is clearly done some incredible stuff with the motors themselves, but I just don't think that the perception that they are somewhere unique in the cell side of things. I think they've maybe done some good stuff on the module and packaging side, obviously, but the cells themselves it's Panasonic cells, right?
I can jump in if you want a bit, Rod.
Yeah.
Yeah. Hey guys. Thanks for running these. These are awesome, and obviously this one is near and dear to my heart. I like the whole EV space. And then I'm kind of elaborating on that question. Lithium and battery chemistries. When you look at all the battery chemistries, everybody's using lithium. Lithium we can't get away from, whether it's LCO, LMO, NCA, NMC, and then LFP, and then even like IM3 New York and C4V and Magnus are working towards in the low, no cobalt, no nickel batteries. They're still using lithium and manganese. So as we go, like the hopper has to be full of lithium before we even get to a point where we're gonna, in my mind, see lithium prices ever go back to a lower price, because the hopper's not full. We don't have enough material. Recycling is still in its infancy. There's companies out there just starting to gain traction in that regard. And Tesla is, as much as they do a lot of work, I think all their work is how they manage how much those batteries are actually consumed through their innovation in their motors, in their heat pumps, and all the stuff that is drawing down their batteries. They're doing a better job at managing them rather than actually designing, a new chemistry. The Tesla isn't in the chemistry designing phase of trying to figure out new battery materials. They may use innovative stuff, but again, like Rod said, it's all Panasonic, and rightly so. Like, they have the know-how, they've been doing it for years, and I think we see the same thing in the EV space, where Tesla's doing a great job at bringing the EVs to market, but all the other more established OEMs are doing a better job at quality control, right? They don't have so many issues with production, because they've done production for decades and decades, where Tesla is ramping up on that. So you see Tesla struggling on the production side, but innovating on the technology side, and our OEMs are slower to embrace the technology changes, but they've got the manufacturing down. So it'll be interesting to see where it goes, but I think the lithium is, we can't get rid of it. And then with the solid state, you're still going to use the same critical battery metals. You're losing your electrolyte. So you're just moving to instead of a liquid, it's just going to be a solid. So it's not like our chemistry changes that much. And in speaking with some battery recyclers, the solid state, it can be processed the same. It's not like it's different technology. It's the same materials, just a little bit different electrolyte in there. But and then I had a question for you, Rod. I know, just as I'm thinking with the Tesla Semi, and just a small aside, but I know, like, the full size semis in North America are much wider than Europe. Do you know if the Tesla Semi is spec so they can use the same platform globally in markets where they can't fit as wide of trucks, or industry doesn't use as wide of large or long haul trucking?
I don't know with Tesla in particular the answer to that question. Just to kind of tangentially, it's not purely related to the commercial side, but I did want to bring up this one other kind of headline, that one interesting change with electrification is for the OEMs, the truck makers, in this case Volvo Trucks, which is not the same business as Volvo Cars, but Volvo Trucks is basically structuring it that if you buy a VNR electric, which is their Volvo regional haul electric tractor, they've basically structured it such that, and I remember this, and obviously since it's public now, that it doesn't matter, but I remember when I was meeting with Volvo as part of that team at Ryder, we heard this, and we were just like, you basically are trying to completely disintermediate players like Ryder and Penske from things, which could happen, certainly. But Volvo is doing is that you must sign their gold contract if you buy a Volvo electric truck. So now, instead of just buying a truck from them, you're buying a fully integrated truck as a service solution, if you will. The graphic on my screen is from FreightWaves, had an article today on this topic, so it was timely. But basically, they're going to fully cover the truck. They are going to cover the infrastructure needs. They're going to cover everything soup to nuts, which fully disintermediates lessors and maintenance providers like Ryder. So for Volvo, right, they get more of the value stream, and you may see others try this. But while I was there, they were the only OE that was that extreme. The article does talk about that Daimler said, our truck driver, our truck operators will run the business. We don't need to be telling them or trying to get all up in their business, so to speak. So that's not precisely what you were getting at. I don't know from a sizing perspective if Tesla will be able to get European tractors, on the roads, or what. We still don't know where they're going to manufacture them at all, or if this Pepsi thing is just another, we're going to build a few rather than actually get to commercial scale. So I don't know the answer to that, but there's a lot of these interesting considerations, at least on like the commercial side, because I always get back to these are pieces of work equipment on the commercial side, right? It's not somebody's second car. It's not somebody wanting a Tesla Roadster to go 0 to 60 and whatever the rocket ship on the back gets you to. It's, I need to get work done as efficiently, effectively, and inexpensively as possible, that that is what I am buying this piece of equipment for. And I will say, in the early time, kind of the feedback from drivers was very positive, right? You have this idea, I think, in your head that, oh, these old school truck drivers won't like electric trucks, but actually the ones that do get in them early on, it's been pretty uniform, right? It's a better driver experience. I mentioned at the onset, that I've personally had Volts for many years, and the driver experience, having one pedal drive control, and it sounds silly, but UPS, a real expense item for them is knee issues for their drivers, right? Having to move their right foot from brake to pedal and so on. That it's not an immaterial cost if they can actually eliminate some of the medical expenses related to drivers, and that's just UPS. So there's a lot of really interesting changes and potential benefits for drivers. It all gets back to use case, right? I think about UPS, and that is the prime best use case. It is a return to depot operation. I'm taking this truck from point A to 20, 30, whatever different routes. I'm putting 60 to 80 miles on this truck, not an extraordinarily high number. So I'm cubing out on the truck rather than weighing out. I'm not hauling gravel and stone and whatnot. I'm hauling packages that I'm limited by how much cubic feet I have in the back of the truck rather than the weight. So applications like that, the total cost of ownership is actually already there in many cases. School bus is one, also driven by regulation. But like thinking again about over-the-road trucking, which the Tesla Semi claims to be addressing, that is the least attractive application for near-term electrification. And it's interesting to me that Tesla opted to go that route. Again, I think it was an internal project that they were looking to satisfy their supply chain needs from Fremont and Giga in Nevada, rather than necessarily truly solving. But it's irrefutable that what Tesla's done lit a fire under the other OEs. So even though Tesla was beaten to market by Daimler, by International, by Volvo, by everyone, had they not done Semi in 2017, I don't think that those other OEs would have had the same sense of urgency to bring those products to commercial completion. So you think back about Tesla's mission statement is to accelerate the world's transition to renewable energy, and they certainly did that on accelerating freight electrification.
All right, we have one question here from Blazin' Bill in the Discord. He wants to know, Rod, have you done any research into charging station-driven businesses such as ChargePoint or Blink?
I have done a little bit. Some of them have different models. Not to go too in the weeds. Are they getting paid by whoever's installing it at their location? One of the other issues with a lot of these charging station businesses is that a lot of these charging stations are out of order. That was my experience when I lived in both Tampa and Miami, that many of these kind of public chargers don't work, and there's no incentive necessarily to keep them working. I haven't looked at Blink recently. One of the heads of ChargePoint I used to work with very closely at Ryder, so I know that his view is that ChargePoint has some interesting protocols and controls, but they're more like the Apple rather than the Android, as I understand it. Whereas they kind of want everyone to be in their ChargePoint protocols rather than the same amount of open sourcing that you would expect from Android. I personally don't know how attractive those businesses are. Most of them still don't meaningfully generate revenue and have some significant costs. I know Blink, is it BLNK? I'm going to just pull it up. I actually shorted it at one point last year in my personal account. So it's still trending down, but it's still, again, way, way, way higher than it was before COVID. It's 10 times higher than it was before COVID, and the market cap is still just shy of 800 million. I haven't looked, again, like I said, this was last year I shorted it. I haven't looked closely enough, but a lot of these businesses, Bill, my view is that almost all of them are overvalued. These startups, almost all of them are getting treated still with too much credit, I guess, if you will. I think Rivian, right, it's still a $31 billion company. And you think about Ford is a $49 billion market cap, right? So Ford and GM, are basically right around 50 billion, and Rivian's at 30. At Rivian, has, again, it just speaks to the way I see the market. Somewhat, I guess you could argue it depends where you reside on things, but I think the market is overly valuing the new players and undervaluing the old players in many cases. And also, I don't have the stat handy, but when you think about the industry-wide valuation, right? Like if it's the automotive space, looking at the sum total of all of the incumbent and new players makes the market somehow. I think what I'm trying to say is that the market value of all of the combined players now versus like pre-COVID is still so much higher that the automotive market did not just magically double overnight, right? So somebody is wrong, and I think it will prove out that the inordinate valuations placed on these new, exciting, shiny objects. I've previously referred to it as like .com 2.0, electric boogaloo, like these electric startup companies getting these crazy valuations. It's understandable why, if I'm a Ford and GM, I'm exploring how do I get that valuation, because I may believe that I have a pretty impressive electrification arm that's getting treated like nothing within my conglomerate. So not not as specific to like the ins and outs of the charging station business of a response as you might have wanted, but hopefully that's helpful. And I know I see Chris responded talking about ChargePoint, EVgo, and Electrify America. And you got to remember, Electrify America it was something that Volkswagen was forced to do as a result of the diesel emissions cheating scandal. And Electrify America, they've put a lot of charging infrastructure in nationwide. But even still, it gets back to if you're a state like California saying that by 2035 every new consumer vehicle has to be electric, I still don't see how the infrastructure gets to a position to support that, and that's been the problem all along. I think about Florida, right? If you're evacuating the state of Florida from a hurricane and you have a fully electric vehicle, what do you do? Given current infrastructure, you may be unable to escape the state. Whereas if you have, whether it's a plug-in hybrid or other, plug-in hybrids, of course, have not. Really, folks have gone away from producing them. There aren't so many of them as there were at one point in time. But plug-in hybrids, you can satisfy most consumers' daily driving needs with electrification and also maintain that optionality. But yeah, so Chris has a question about the commercial EV charging space. So Charin is the organization on the commercial side, and just recently pulling up this megawatt charging system is what this group, this multinational nonprofit that was trying to get all the truck makers globally on the same page for DC fast charging for heavy duty vehicles. So this new standard is out, right? You have the combined charge standard. The CCS is kind of your typical one. Obviously Tesla does its own thing, and then there's CHAdeMO on the consumer side. But to get the necessary power flow, more than a megawatt of power to charge these heavy duty tractors, that's coming. That's been shown. Charin's been working on this. I think Charin started while I was at Ryder in 2018 or so, 2017. And they're getting this across the finish line in terms of showing that it can work. But as far as I know, like commercial deployments of this sort haven't really been happening at any sort of scale. So while it's great, right, that they've settled on a charging standard, this megawatt charging system standard, it still remains like where are those going to go? You think about you need to get a payback. If you're going to put a megawatt charger that has that much power, you're probably going to have a substation upgrade. You're going to have to do a lot in terms of trenching and make ready infrastructure, depending on what your depot looks like. So there's a lot of cost. There's also the long lead times, depending on what state you're in. It can be anywhere from months to years to get the necessary permitting to do all of this. So it's going to be a very long transition. I think a lot of these proclamations about it happening in a decade or so are a bit of a reach, and it gets back to what Jake asked. I think that Scott noted too, like that the sheer amount of battery materials necessary to make all of these vehicles, the math doesn't seem to add up yet, in line with what politicians may desire. But we will see what happens. But there's some great reading out there if you were to go on Charin's site and kind of understand. Daimler Truck, of course, is the globe's biggest commercial truck maker, and they were kind of leading the charge on this. No pun intended. But it's good to see, right, that they've settled on this heavy duty standard to get these big trucks able to charge in the necessary pace, right? Because if you have drivers sitting there and the vehicle is not being used, I mean, that's opportunity cost. That means you have to pay for a second driver, right? Depending on what the application is. So again, these are work trucks. All of this is not just science projects for them. It's, can we do the job as well or better at a better cost? And in some applications, it does make sense today, but in others, I think it's still trying to fit a square peg through a round circle, so to speak. So Chris, hopefully that's helpful, like on the commercial EV charging side. Hopefully for folks who hadn't heard of Charin, that gives them something to do some research on. But I would add, while I was at Ryder, this was a very serious consideration. The Ryder had to consider how much cost it would be at each facility to try and put a DC fast charger in. And if you're only using a van that's doing tens of miles per day, you don't need a DC fast charger. You could probably make do depending on the application. Going back to those UPS step vans, a UPS van where it's going to go out and run routes 60, 80 miles, and you plug it into a level 2 charger overnight, and you have a managed charging system where the software knows where that truck, how much energy that truck needs by tomorrow. And even though you have 30 UPS trucks plugged in, the system can only have a mix of them charging at the same time, so that you're not having the same maybe overages, right? There's demand charges, as Californians I'm sure know, depending on what time of day you're charging. So I remember it was funny in media, right? I think within a few days of the 2035 ICE ban announcement, the state of California said, please don't charge your vehicles during these times. So I'm still not sure how California will do what it wants to do. You also need to think about, on the internal combustion side, the engines have gotten so much cleaner, more efficient, better than they used to be, right? When you think about an old tractor belching black soot into the air, well, that's a 10 plus year old piece of equipment at this point. And if you're buying a brand new Class 8 tractor, Freightliner Cascadia today, and you're getting almost 10 miles per gallon, which is great for a tractor, it changes, I think, the consideration, and obviously want to have clean air for people in their communities, and you definitely want to get older trucks off the road. But banning the internal combustion engine, I see a lot of challenges with that in quite a few places. So it remains to be seen. But obviously, lots of money getting thrown at the problem, and it is certainly the future. So it's just a question of how far out that future is, right? Yeah, pantographs. So Scott noted, transit buses working on, different, like on-road charging is something that I'd seen years ago at Ryder, but basically the trucks have a connector overhead. So here we go. This is old. This is 2016. But Sweden creates world's first electric road. So you can see from the visual, if you're following along, that the truck is actually connected to an overhead series of infrastructure. Again, this goes back to the infrastructure problem. How much does it cost each mile of roadway that you build like this? If you were to build this roadway and have it usable, in high density areas, maybe you build this sort of thing in Southern California from the ports to Inland Empire to the warehouses, right? Could that alleviate some of the infrastructure needs, or at least focus them? There's so many different ideas out there. I haven't seen the pantograph getting much commercial traction in the years since, but certainly I could have missed something. Yeah, here you go. Go ahead, Jake.
I have a question. So what do you think the best sort of so obviously right now, first order idea is electric vehicles, sort of second order would be sort of battery tech, stuff like that. But obviously focusing on infrastructure ideas, what do you think of it is a good third order play on sort of changing infrastructure technologies?
Jake always with the hard balls. An interesting, and maybe I don't know if it's a third order idea, something that's super interesting about this changing world is the idea of, in the world today, if your diesel truck is fully fueled and other folks needed fuel, you can't just siphon that diesel fuel out of your truck and send it elsewhere. But with electrification, if you have a fleet of trucks or buses that have these many 100 kilowatt hour battery packs, well, if you have a fleet of 100 500 kilowatt hour packs, now you have a 50 megawatt virtual power plant. And there's different vehicle to grid applications that are being explored. They've been unfortunately having to dilute shareholders, but NVVE owns some intellectual property that I found interesting. I don't have a position in that. I have in the past, but they have some interesting intellectual property on vehicle to grid. They basically have the patents from University of Delaware that was working on this stuff about a decade ago. They have some commercial revenue coming in from Denmark and Southern California and a couple other places, but there's interesting monetization pathways with the ability to send electricity back out from the pack. Obviously, Ford with the F-150 had like an upgrade that you could pay, I think it was $3,000 or $4,000 to let that be your backup generator for your house, so that you could send power back from the truck to your house. So, like these vehicles become just moving massive battery packs, right? And ways that the battery pack can be leveraged to provide different grid services, I think is really interesting. I don't know if that fits the definition of third order, but it was kind of a related to infrastructure thing that pops into my head.
I don't think it necessarily fits the idea of third order, but it certainly is a very interesting point. I never really gave that much thought, and that definitely gives me some food for thought. So you accomplished your mission today.
Perfect. I love it. Very good. So, Scott, thank you, and Jake, thank you, and Bill, thank you for the questions. It's 5:20, so I am happy to keep going on electrification, whether we talk commercial or consumer. Obviously, we didn't circle back to Tesla and sorry, not Tesla, Twitter and Elon. We don't need to do that by any stretch. But yeah, does any other questions, lines of thinking folks want to go down?
I mean, Since I guess no one else really wants to say anything, I'll continue. What's your opinion on sort of solar leasing or lease to own sort of things? Similar in a similar vein, obviously, the goal is to get more clean energy because it doesn't really matter if you have a fleet of electric vehicles if all the energy you get is high pollutant. It really doesn't matter. So, I guess what's your opinion on sort of some of the initiatives with leasing to sort of bring together a more cleaner grid?
Yeah. So again, for anyone in the Discord, I pulled up Lazard has done these analyses for levelized cost of energy and comparing solar versus other. So I guess like to the question about solar leasing, I mean, on an unsubsidized basis, as the graphic shows, utility scale solar is in the ballpark of the levelized cost for like a gas combined cycle, wind. But then when you add in the subsidies, right, like that's where you really can get some pretty impressive cost advantages versus fossil energy. And obviously the fossil folks will retort, well, what happens when the sun stops shining and the wind stops blowing? And I think that's where some of these different interesting energy storage things like come into play. So it's like I don't know, to specifically say like with your question of how attractive are solar leasing opportunities, I really don't know. I've never looked into that, but I do know that like what is going to be very important is to kind of couple these intermittent generation facilities with storage, and obviously that adds a lot of cost, but without that storage, you're going to have some energy rationing, and you don't necessarily have the ability, like with California, you have that famous duck curve where it's like where demand peaks is not necessarily where energy production peaks, and there's gaps in providing the energy needs. But like solar, I haven't followed it so closely with the like investment tax credit and the production tax credit and how much that helps the math on things like but I would expect that the math will continue to move favorably for solar and wind to be really attractive areas of investment for power generation. I just don't know the answer to your question on like the leasing stuff.
Okay. I mean, I was more thinking. I mean, yeah. I mean, either way, it doesn't work out. But I was thinking more on the sort of lease, like sort of like how people are bundling up these solar leases as like they're the next version of an MBS sort of thing. Was more what I was focusing on. But
I've never. That's beyond my familiarity. This is a good visual. This visual I have up right now. Let me get my camera out of the way. Just showing over the last decade or so, the solar LCOE, levelized cost of energy decline has just been incredible. Going back to 2009, you're the most expensive marginal cost of power at 359 per megawatt hour, and then go to 2021 and solar is the cheapest at 36. So a 90% reduction from 2009 to 2021 in the solar photovoltaic for energy production. But again, it gets back to right, like you still need to have baseload power. You still, if you don't have storage, how are you going to address gaps, et cetera? But the energy revolution is with us. It definitely is going to be a space with a lot of opportunity for the necessary infrastructure. Transmission is something that I haven't done a lot of work in, but I do think that transmission is really interesting, that there needs to be investment in transmission. And I actually don't know what the industry structure looks like. I mean, I know a lot of utilities are publicly traded, but they have regulated rates and the like. So I don't know of offhand of interesting opportunities. I know, NextEra Energy has been a home run for those who've gotten into it. Going back and looking at the max chart, and that's just pretty phenomenal. It's trading at 77 right now, and you could have gotten into it, for $12 in the GFC. So, yeah, I think there's going to be a lot of investment in the space. I'm sure there's going to be interesting ideas, especially like green bonds, right? Is all things ESG keep getting more and more, I guess, investment dollars oriented in that direction. I'm sure there will be very interesting, creative financial products that people much smarter than me put together and sell to pensions and other investors. But
Rod, I'd like to loop it back to Twitter and Elon to end the discussion a bit. And
sure.
I think it's interesting. Elon tweets, buying Twitter is an accelerant to creating X, the everything app, which was kind of talked about a little bit, but I think it's really like a compelling theory because he told Twitter staff apparently in the summer, this is all revealed in the subpoenas, that the company should emulate WeChat, which is this super app in China that like combines social media, messaging, payments, shopping, ride hailing, like everything. And Musk said, you basically live on WeChat in China. If we can recreate that with Twitter, we'll be a great success. That's compelling to me. I think Twitter has been pretty stagnant. I mean, we're on Spaces. That's a relatively new feature. But there hasn't been anything to dive them more into messaging and some more features like that. Like WeChat is like how you pay when you go to a store in China. You scan, a QR code with WeChat. That's not really. I mean, you have Apple Pay and Android Pay in America, but nothing on that level. So I was curious what you thought. Is it just another pipe dream from Musk, or is it something that is a good path for Twitter to go down?
Yeah, I saw him post that he's talked about it. I'm very much an Elon skeptic. Uh, I I can. He's definitely likes to make bold claims and doesn't often uh, meet them. I guess he claimed that Twitter accelerates X by 3 to 5 years, but at least he acknowledges he could be wrong. I don't know what his initial base case for X was. But yeah, I mean, if he could make Twitter more than just in a means of consuming information and shit posting and the like if he could add commercial, capabilities to it. Obviously, people have doubted him before, and he's done it. And I will doubt him again, and maybe he'll do it. I wouldn't bet on it. I mean, he's buying though. I think Twitter for like a really crazy valuation relative to the cash that it generates. So I do expect him to fire a hell of a lot of people at Twitter, and I'll be definitely curious to see how it evolves. I mean, I use Twitter extensively. I like the platform. I hope that whatever he does enhances the platform. But I mean, given what he said about autonomous vehicles ad nauseum over the years, I'm reluctant to take him, at his word when it comes to any sort of deadline. uh, Knowing, the semi, I still will believe it when I see it about any sort of scaled production of it. But yeah, that makes the market, right? I think we'll see the deal close. Just going back to the deal itself, I do think the deal closes at 54.20, which is, interestingly, the stock I think traded down today again at 49 and change. So there's still almost 10% gap between the deal price and what the market is currently pricing. But yeah, for X, I don't buy it. We'll see what happens. But then, with that said, I think we can wrap there. It's been an hour and a half. I hope that everybody enjoyed this third Wook in Review presentation. For those who only joined in audio, there was an accompanying video stream that will be made available on on YouTube after we wrap and I send Joe the recording. You can see my lovely face and our fancy schmancy little setup here that we tried out for the first time. We genuinely, though, are trying to make this useful for people. We obviously have now done 3 of these Wook reviews. We have our first Wook book club coming. We have not 100% finalized the time, but barring any unforeseen changes, we will be discussing Richer, Wiser, Happier in the Wook Discord on Tuesday, not this coming Tuesday, the one after, which is, I think, the 18th. Joe, correct me if I'm wrong. Yes, Tuesday the 18th. We're thinking of doing it around 7 p.m. Eastern time. So if anyone has any feedback if there's a better time for them, if we get a lot of feedback to the contrary, we can change that. But as of now, we're going to plan to have our first book club discussion on Richer, Wiser, Happier in the Wook Discord on Tuesday, October 18th. And at that point, we will unveil what the second book club will be. And we've heard your feedback. We do intend to eventually cover some single name securities and do some more in-depth fundamental analysis and have some more discussion like that. As all of you know, there is a stock in particular that's near and dear to my heart that we will likely lead off with first, but we just want to ensure that everything is lined up first before we do that one. So again, I'm Rod Alsman. I'm the managing director at Wook Capital. We appreciate you joining this Wook in Review, and I hope everybody has a fantastic weekend. Thanks again.